Hi, I'm Ben Elowitz, and I want to welcome you back to Razor's Edge. As you know, I started this podcast because I wanted to uncover the secrets of what the very best CEOs do so differently from the rest that lets them create a capital advantage for their companies. That means more money, more capital, raising it faster so they can get back to building the business and doing it with less dilution. These extraordinary CEOs, they outraise and then outperform their competition, and they end up owning their markets. Today, I have a powerhouse guest for you who has done just that. My guest is going to be David Shim. David was the founder of Placed, the geolocation-based ad tech media company. David took that company, Placed, from solo founder up to a $200 million acquisition by Snapchat. He then spun it back out to Foursquare, where he then became the CEO of Foursquare, raised $150 million, led the company to its first full year of profitability. David went on to become the founder and CEO of Read.ai. Read.ai is the fastest growing AI productivity app where he has raised $82 million, including a number of back-to-back rounds starting in 2021. The cool thing about David is he has been through huge market extremes and cycles. He's gone from the worst of times where he had to duke it out in the ad tech world, a space I know very well. David calls it the least valued space in the world, to the other extreme when he founded Read.ai at just the right moment. Everybody was suddenly on Zoom during COVID, and he was the one who would manage to build an app that can read signals and coach you to performance on your Zoom calls. We are going to go through a deep dive into the real highs and lows of fundraising today, from being a hot entrepreneur in a market that's on fire with people chasing you, to the painful grind of hustling in a sector that's out of favor, getting rejection after rejection. Here's the thing. Don't think of being a great fundraiser as having all that much to do with luck. Instead, focus on the skills. That's what David does. He managed to get a capital advantage even when the climate was incredibly challenging. He's got great insights about what founders can control to get a capital advantage in whatever circumstances they're in. So get ready for a masterclass in navigating the peaks and the valleys of the venture capital landscape. Enjoy. Hey, David. It's great to have you here. I'm excited to talk to you today. I've known you for many years, and you've got such a great reputation, not only as a CEO, but also as a fundraiser. You've had a bit of an exciting ride over these last few years. Not to say anything is easy when you're an entrepreneur, but I can't wait to hear about your adventures. I thought we'd get started with a quick lightning round of some questions. How does that sound?
No, it sounds great, and I'm looking forward to this conversation, Ben.
So, first question, if you had to describe your leadership style in one word, what would it be?
Direct.
Direct. Excellent.
I think it's important to, especially at a small startup, to be direct in terms of what you're looking for, what you want, so that your team understands versus, I think when you get into a bigger organization, you're kind of about the politics. Like, hey, what's the right way to frame this? Should I talk to their manager or should I talk to the direct report that I want to interact with? And those steps actually create a lot of issues when you're in a startup because you don't want those layers. You want to be able to go straight to the person that you want to talk with to say, this is broken. Let's go fix this. How do I solve this problem? And how do I do it in a respectful way?
Got it. Do you have a favorite book or podcast that you feel like every entrepreneur would benefit from?
I would actually say the earlier episodes of My First Million, because they talk more about hacking. How do I figure out different business ideas? How do I try different things out? Both of those kind of hosts have actually become very successful in their careers over the last 4 or 5 years. And so what you find is like the stories and the narratives are a little bit different now versus early days. It was like, how do I grind this out? How do I build an email list to 5 million in revenue?
Yeah. If you could have any investor in the world involved and on your cap table and in your board meetings, who would it be?
Yeah, I mean, this is going to sound a little bit like a homer, but I would say the investors that I've had that have been loyal to me and I've been loyal to them. I think that level of loyalty, especially when things are going poorly, is really important. So I'd say, Matt McElwain has invested in my last 2 companies and it was no questions asked kind of investment. Julie at PSL, invested, no questions asked, I'm ready to go. So I think that level of trust is something where it's hard to build. So I think there are aspirational ones where it's like, yeah, Fred Wilson would be great. There's other people in that group, but I would say I'd stick with the people that I know because they've been loyal and we've had great success together.
For new investors, what's your biggest green flag and your biggest red flag?
They're both the same. The question I always ask is like, have you tried the product? And if they say, no, I haven't tried the product, it's like, how interested are you that we're going to do a 30-minute to an hour-long call and you can create a free account on the website and actually see what it looks like?
Yep. And when an investor doesn't get back to you and you're in the process of raising money, do you write them off or do you write them again?
I write them off. And not in a bad way. If they want to reach back out and reconnect, that's great. But investors generally know within the first 5 to 15 minutes if they want to invest. And then it becomes more of a due diligence process to say, how do I cover my ass when I want to put money in, but I want to make sure I did all the due diligence, that I checked the boxes, that the legal agreements are in place, the contracts are real, they're not just hyping up the pipeline. And so for me, that is kind of a key point.
Love it. Love it. Do you love fundraising or do you dread it?
I'm indifferent. I understand it's part of the game.
Really?
You have to raise money. It is your job as the CEO or as a co-founder or founder to go in and make sure that you don't run out of money. I've had a couple CEO friends where they ran it to the very end and then they shut it down very abruptly and they didn't actually think about the numbers. So I think that is kind of critical.
Let's give everybody a chance to get to know you. One of the things I love to do in these conversations is start by asking the question, like, how would you introduce yourself to an investor if you were in a pitch meeting? How would you take them through your background to take advantage of those first couple of minutes when you're getting to know somebody?
Yeah, so I will start with the track record of success that I've had. And it's just important because investors are very much pattern recognition. I was CEO of Foursquare for about 2 years. And so that's kind of where I start because they're like, okay, now you've kind of given me that social cred. You've been a CEO at a very large company. Now, was it successful or not? They have to kind of dive in. So then I will back it up to say, we actually got to about 120, 130 million in revenue. And when I was CEO, we had a first full year of profitability. So like, okay, that's kind of interesting. I wouldn't have expected that. So that level sets it. This is where I've kind of tuned it a little bit. I used to go 5 to 10 minutes about my prior company and my background, like so Placed. But the problem is if you get too stuck on the background stuff, I realized 10 minutes into the call, I'm like, damn, I have not even talked about the current company that I'm working at. Yeah. My background just needs to prove that we continue the conversation. It doesn't need to be that I'm applying for a job. So from that standpoint, I say like I started Placed, solo founder, 2011, sold it to Snapchat in 2017 for about 200 million. 2017 to 2019, we were the only profitable division at Snapchat. And then we got spun out in 2019, partially because Snap was refocusing on their core business of advertising and we were more about attribution. But we were actually bigger than when we were first acquired. So it was a very good exit for all parties involved. And they're like, okay, so he's a startup founder. He's done it from an idea. He scaled that up. He's also a good player, a good kind of soldier. Now, all those things kind of align to say like, okay, I feel good about this person just generally on background. And then it goes into, let me tell you about Reed.
You're intentional about it, right? You're thinking through what's the experience I'm going to create for them and what are the strengths that I have to merchandise to them.
Absolutely. You're there to go in and say, prove that I'm a worthy person to invest in if you don't know who I am. And then you consider the idea and you say, okay, those two things combined, am I interested? And part of it is like, they might not even believe fully in your idea, but now they're like, I trust you somewhat. And now you're answering questions in a way that makes me trust you more. All right, I like this guy or girl.
Yeah, and you've done a lot of other things that you're not even mentioning, right? You founded a company while you were still in school, founded another company super early on at Avenue Razorfish. You worked in finance. You were early at Faircast and Web Trends, a couple of very notable startups in the ecosystem. And you're saying, hey, I don't even need to mention those because I can accomplish what I need to just by keeping it short and focusing.
Exactly. You want to pick those points because you don't want to go into a 30-minute narrative about your history. To be very clear, though, like if I didn't have the track record of success that I have right now, my pitch back then was like, hey, I did work at Avenue A. I was early Faircast. I was Web Trends with web analytics. I know this space. And then I would pull in something else that's kind of interesting where they're like, okay, this person is an outlier. And my outlier thing was at the age of 17, I got emancipated from my parents, not because I wanted my own apartment, which is the most normal thing that people do, but it was to go in and actually trade stocks. And so I got emancipated. Then I got my Series 7, 24, and 63 licenses, which no one under the age of 18 had done previously. And I was the youngest registered investment advisor in the nation at 17. Then they're like, okay, he's an outlier. He actually pushes it a little bit. That's kind of interesting.
Smart and super deliberate. And like, you're looking at what's going to actually register on their radar. A lot of entrepreneurs, when they get started raising money, they feel like they're obliged to give a bio. And you're not saying, let me give you a bio. Instead, you're saying, let me give you reasons to invest in me.
Exactly. It's an elevator pitch for yourself. It's not a LinkedIn profile.
Yeah. Let's talk about Read.ai. You started Read.ai in which year?
So peak COVID. I was on one of those calls that you're like, I should not have joined this call. I should not have turned on my video. This is a mistake. What I started to do was I surfed the web, but I got kind of bored and I started looking at different people on the call and seeing, are they paying attention? No, you're not. And one of them was that I was looking at was wearing glasses, and I saw the reflection and the colors matched the same website I was on. And I was like, oh, they're on ESPN.com because I'm on ESPN.com and I can actually see the exact page on his glasses.
That's awesome.
So I went in and said, okay, this is kind of interesting. Is anyone doing anything around attention and engagement and sentiment of a call? Are there any models that exist today to go in and measure that? There wasn't. Outside of like old school, like TV commercials where you've got a high fidelity camera that's pointed at you and it looks for those micro expressions, but it wasn't productionalized. It wasn't designed for hundreds of millions of people. So we said, okay, this is interesting. It's a big problem. It's a big opportunity. The next question I was like, is anybody else working on this? And this is what a lot of founders forget to do is do the research. And I was lucky enough to talk with Eric Yuan, the founder and CEO of Zoom. I shot him a note. And I said, hey, quick question. Are you working on anything to measure engagement and sentiment in real time for a meeting? And his feedback was, hey, you should work on this because this isn't a priority right now. I was like, okay, that's pretty good validation to say the company that is growing the fastest in the world at the moment for video conferencing says this is a good idea. So I started to dive in a little bit more, and we were able to build a model that goes in and measures sentiment and engagement in real time. And so long story short, we built a very compelling product for meeting notes across Zoom and Google Meet, as well as Microsoft Teams. It's the fastest growing meeting note taker ever. We are getting about 50,000 net new signups on a daily basis. So we're on a run rate of about 12 million new signups on top of our existing users over the next 12 months. And it's only getting bigger. So that's been great. And then we've also said, outside of a meeting, what content do you have? Well, before we had this podcast, we had emails that went back and forth. There were conversations before this meeting. All that information is siloed right now. And what we believed was there has to be a third party that brings that all together that then acts as your AI assistant to enable discovery and actions.
So when you got it started in 2021, where were you when you went out to raise money? What was the first conversation? How far along were you?
It was still really early. Like there was some research that we had done, but that was about it. We were going to go out and actually talk with a bunch of folks. But again, I knew Matt, I knew the team at Madrona, told them about the idea. They're like, this is interesting. This is compelling. We know who you are. Let's do this. And they cut the check. And then PSL did a follow along as well. We raised $10 million. And that was peak ZERP. The only thing that matches that kind of period of time is now early stage investments in AI.
Did you even have to take rounds of meetings with new investors, or did you choose to take rounds of meetings with new investors?
I didn't choose to. So I think, especially in the early stages, you don't want to over optimize. And data is so readily available now. You can get an idea of like, what area are you in? What sector? What are people raising dollar amount wise? And what's the valuation associated with that? So that information was readily available. And could I have gotten even more in theory? Yes. There were other investors that I had met at Foursquare that were interested in Snapchat, et cetera. But for us, it really came down to like, who do we want to work with? Who will move very quickly because we don't want to spend a bunch of time fundraising. It really turned out to be the right decision because if I had spent 3 months pitching, trying to optimize to get 10 or 20% more valuation or more cash, I think we would have been in a really weird spot at a certain point where after that kind of ZERP started to fall off, people were like, what are you doing with money? Are you going to actually even live up to your valuation? Not just for Reed, but for every company that got invested in that period of time.
So you were a hot entrepreneur, a well-known entrepreneur with a super established track record, a bunch of relationships, a bunch of folks who were kind of at the waiting to do something with you on repeat. So what's the journey like from there when you're in a hot spot for the VC market? What's your ability to tap capital and how does it feel?
It felt great. I had been in other scenarios where it was very difficult to raise money. I don't think we've said it publicly, but we raised 10 on 45. And really, people were like, okay, this is a company that's going for a moonshot. This is a company that wants to be very big, because you don't raise 10 on 45 to sell for $100 million. Like, this is to build a generational company or something close to that. And so that got people excited about it. And the second part was with Read, I was able to go in and say, like, who are the best people in my network? Who do they know that they can make introductions to? And that made it easier to kind of go out and recruit and bring the team on board. And so we were able to hire faster. We could go in and say, like, hey, let's be competitive in market versus try to be frugal.
Yeah, if you can have a capital advantage and your capital cost is lower, right? It lets you have a team advantage. You can go ahead and hire more, hire better, and have room to make mistakes. And then that gives you a business advantage, which then probably sets you up for another capital advantage in the next round. So,
Absolutely.
So let's hear about the next rounds. Being that you were in a hot spot, what was the glide path for the next round?
Yeah. So this was kind of an advantage. Capital attracts capital, but it also attracts growth in a lot of ways, or the ability to find growth faster. And so for us, we didn't have to worry about monetization. And we were more about, hey, can we find product market fit? Can we find a use case for this technology? And so we built the technology and started to dive in more, and we made iterations. It took us almost 18 months to get to product market fit. And had we not raised the $10 million, we probably would not have gotten to product market fit, because we would have either run out of money or had to go back and raise money. But the focus was go find product market fit. That was the directive with this investment dollars.
Excellent. So you tuned the product pretty substantially. And did that give you a decent way to make the pitch for more money?
So this is where it was a little bit different. We had people pinging us, but as someone who's raised before, I knew that it was not the time to raise. I did not have a compelling story at that time. I had, 5 to 10% retention rate. And I think people get lost in this. Like, you're going to go and say, hey, I got 5% and I got it to 8%. So I'm up, 60% on a quarterly basis. Well, the investors, if they don't know your company, they're going to look at it and say, like, you're still 92% drop off rate. That's not great. Like, the story wasn't compelling enough to go out into the market. And we don't need the money right away. So let's make sure that we've got a compelling story in market. And when we were starting to think about raising, we started to see that hockey stick happen. And then 2024, it got even steeper. And all of a sudden, all these VCs started pinging us. And they said, like, hey, do you want to catch up? Do you want to catch up? One of them was Goodwater. The investor there was Scott Shao. But this is where the investor did something different that really stood out to me. He said, we're seeing these analytics that show you at this growth rate versus your competitive set. And then I compared it against my internal charts, and I was like, oh shit, this is actually pretty close to my data. This person is a little bit different. This person is special. We kept in touch. He kept on asking really smart questions. And then I met with Cody, who was the partner there, and we had a great conversation, great relationship. And then they moved very quickly. And they were like, hey, we like you. This is what we're seeing on the numbers. This is how you're kicking ass. We'd love to be able to invest in this round. And we hadn't prepared anything. Like, there wasn't a 2025 plan that we had finished yet. It was just kind of like a 2024 plan. But again, it went down to, like, do I like them as a partner? Absolutely. They're a consumer/enterprise investor, which is pretty rare in the VC space. They had a track record of success. Cody was the former CEO of Activision Blizzard. So it's like, hey, this is going to bring new skills and talent onto the team. This is good. So we had the conversation. I met the rest of the partners, and it moved very quickly from there. Chiwa was one of the partners there, the co-founder there. He flew up to Seattle with the term sheet. And so two things were really cool about that. One, you're the founder of the fund saying, like, hey, I'm going to fly up to Seattle. Let's talk about this term sheet. Two, he was really transparent. So what do you want? And as long as it's within reason of what we've got in mind, let's go do this thing. And then we essentially signed the thing that night. So I think from my standpoint, that was fantastic. He's so committed. He's willing to come up. He's kind of hustling to go in and say, like, yeah, I'm going to sell them in person.
This is back to your green flag. These guys have done their homework ahead of time and then go in the extra mile. I can't help but notice, both these rounds, you were not having to go out and run a big process, but it sounds like you were super deliberate about designing to make the company investable in the first place. Like, you weren't saying, I'm going to take what I've got and go shop it. Instead, you were saying, no. Here's what we need to do, where we need to move the business before it really should earn venture capital. Is that right?
100%. Especially first-time founders, you get lost in the weeds of pitching an investor, and that becomes your outcome, when in reality, it's a step. It's not the outcome at the end of the day. And it's kind of cool to say, I raised $10 million, I raised $20 million. But what you don't want to do is run an entire process too early. the market is like more transparent than it's ever been. I think almost every smart VC now has some type of feed and analytics team that looks at that data. So they already know what you look like. They already know what your competitors look like. So you have to kind of be in that right spot, or they're going to pressure test you so hard and you're going to fall apart because they know the data. There's no more like, hey, look over here. It's this shiny thing. Give me $5 million. It's like, no, you don't have the traction. I see your competitors growing 4 times faster.
Yeah. So since then, you've designed for traction. I know you've made some deliberate decisions in the product that were about being able to show growth. You did that all the way up to your most recent round. Do you still think about that of saying, hey, I need to design for the right capital journey? It has to be great for the customer, and it also has to be great for the capital journey I want?
Less so, but I think it's more of a fact that our customer journey is aligned with the capital journey in the sense of like the customer journey is something that is very investable. It is something that is very compelling. So our goal is to get to eventually 100 million sign up run rate. And once we get to 100 million sign up run rate, we will be a top 10 AI application globally. And so that's our ultimate vision. When you take that vision and you say, how is that going to be monetized? Well, if we get to 100 million users using our technology where they've connected their data, they trust us, we're giving them actionability, we're giving them value. So I think from our standpoint, I'm building to get to the 100 million, but if we get to that 100 million run rate of users, then that VC money will naturally come. And I think that's what also happened when it came to our Series B. Smash Capital, great analytics. They were able to go and say, hey, we think you're growing at this rate versus this. And we got this because we've got web traffic data as well as credit card data. So we can go in and see how you're comping. And yeah, you're the fastest growing productivity AI solution that we've ever seen. And they're like, we've got background in gaming. We've got background in SaaS, AI. I was like, okay, if you buy into the vision of 100 million is important from a user base. They're like, yep, that's what we want. I was like, all right, again, I could go out and try to over optimize. But for me, it was really the right partners. The valuation was right. And it was building on the momentum. And for us now, it's been good where we've got a significant portion of the funds that we've raised so far to date still in the bank. We're expanding the team very quickly, but we don't need to raise. And I think that level of confidence is a big thing that you're not going to have that at a seed round. Maybe at the A you'll get it. But once you're at that B stage, it does become a thing where it's like, all right, I can run with this thing. And then the fundraising can come after. Like that's not the focus because we've got enough to keep the lights on for a while.
Yeah. So with Reed, you've been in the sweet spot of venture capital in an attractive sector, and you've impressively built the business to fit with what venture looks for when it's investing. It can feel much easier when you're doing that and you have the ability to have preemptive rounds. You're not always in that position though, right? No. And a lot of founders aren't in that position. So if you go back in time to Placed when the product market fit with venture wasn't quite as seamless, what were those fundraisers like?
Those are tough. So going back to Placed, there are a couple learnings. So we raised a $300,000 seed round. That was pretty easy, but it was $300,000. That's kind of like the old school days. This was back in 2011. Then we raised a $3 million round from Madrona. And during that Series A process, we were growing, but we weren't necessarily at full product market fit at that point. We were doing analytics around location. We were in New York Times, Wall Street Journal, really cutting edge technology, a bunch of patents. But no one wanted to pay for it. We were also really low on cash for a while because the $3 million had kind of burned down a little bit. We were kind of close. And if people don't know, when you take on debt or venture debt, that's really the VC going in and saying, we're going to be the backstop for this loan. So do we believe them enough that we will be their backstop for the loan? Madrona, again, this is why I love them. They said like, hey, we're on board. You can do a debt round. And so got the green light, took some money down. And we were able to go in and take that extra like 6 to 12 months that we had and actually get the revenue trajectory going up really like a hockey stick. And before that, we tried to raise the B. I want to say I talked to like 50 investors, maybe 100 investors during that time. And the thing was, I didn't have product market fit or I didn't have enough of it that they were ready to invest for the Series B. I was in a space called ad tech, where if people don't know, ad tech back then and even now is the least valued space in the world, I would say almost, where ad tech companies, if you have 100 million in revenue, your valuation a lot of times is $100 million. And so when VC saw that, they're kind of like, hey, you're an ad tech company. You're growing great, but it's still early. My kind of pattern match says I shouldn't invest in this. I should just wait a little bit to see if you got more trajectory. And the thing I'll say is like, when it's that tough road, a couple things, you got to have a narration layer because I should have actually adjusted my pitch. I took it as David's going to be the guy that embraces ad tech to say, we're ad tech, but we're going to be different and we're going to be huge. I probably shouldn't have done that. I should have probably done more around the data science, the analytics to go in and say like, hey, we're building a platform for location, because that goes in and lets a VC say, hey, the ad tech valuation versus the analytics valuation is 25 times revenue. So this is something that I can invest in because this happens. I didn't adjust my pitch. And I think that hurt us a little bit when it came from the A to the B and raising that initially. So the venture did help us get to the more trajectory. We ended up finding a company, Two Sigma Ventures, great folks over there, where they said like, hey, we actually like the data science portion more than we think about ad tech. They had already a thesis in mind for that. Had they not come along, like, I don't know if we would have raised another round. We might have had to go back to the well for venture debt. And ultimately, it's a great investment for everybody. We sold for 200 million plus to Snapchat. It was a great exit for a lot of our investors. But it was a tough road.
One of my companies, Wet Paint, we were at the straddling of media and technology. And over the course of running that for several years, which was in favor between media and technology, changed multiple times. And, if you're going with a venture heuristic, you're going to be able to get a term sheet in a lot fewer meetings, and you're going to be able to have a much better valuation than if you're against a venture heuristic, right? Or you're positioning in an out of favor sector. So sometimes that means you have to actually reconsider the business. Sometimes it's about the narrative. Sometimes it's kind of a combination of both, right?
100%. And I think when you pitch the narrative as well, you have to look at, is your narrative in line with the VC? And I ran into that a couple of times. Like, if you're fintech and you're pitching to a company that does consumer, if it's not consumer fintech, you're probably not the right fit. Now, will they take time to understand more about your business because it is interesting and compelling? Maybe, but it's not going to get you super time. So you almost have to pre-qualify a lot.
So for Reed, you kind of went out there and pitched to, not very many, like kind of close to zero outbound pitch meetings. For Placed, how many for some of your top rounds, like the Series B?
Oh, I think when we started the process, for the first time we tried to raise our Series B, it was probably 100 investors. 100 investors, probably got like 90 rejections. Some of them, they just ghosted me. Some of them, they said, we like you, but you're just not ready yet. Whatever.
And with what you know today, do you think there's anything you could have done better back on that Series B?
I think it really is the narrative and the storytelling. And it's not just having a good story on paper, but it's actually being able to tell the story to get someone excited about it. And I think there are very few people that know how to do that. And the only way that you can get better at that is to practice. And it might seem dumb, but I will tell you, most people now, when they go to pitches, they don't practice that much. They just go in and they say, I'm going to do this spiel. I'm going to wing it. And if you're early stage, if you're having a hard time raising money, do it like Shark Tank. Go in and say, how do I pull them in? I need to get them emotionally attached, excited about that opportunity.
Yeah. So knowing what you know now, and you've kind of seen both when you're in the hot spot of what's in favor and when you're in the lower spots of what's out of favor for venture, like, how do you gauge investors' interest in those two differently? And how do you think of converting investors differently?
Yeah. In a situation where you've got VCs that are chasing you, I think it's important to maintain those relationships because you need to move very quickly. If you're hot and you want to do a process, you got to do the process pretty much as soon as you get some level of interest, because this market very specifically, if you're AI, if you're in a hot space, they are going to preempt because they understand that the way that the market is designed is if you don't preempt, you're too late, you're not going to get in. But the preemption does require some level of relationship building. They're not going to come in cold and say, here's a check. So I think with those founders that are listening in, it is going to be important to go in and say, I do need to build those relationships. What was really helpful for me for a while, it's like, write an email newsletter, do it once a month, give some additional information, how you're tracking on the metrics. On the flip side, when you're not doing as well, like let's say your business is solid, it's growing, but it's not the growth of AI. It's growth of a traditional SaaS startup. It's the growth of a traditional consumer startup. I think one, you have to be realistic. I think a lot of folks go into it to go in and say, hey, I see all these AI companies raising money, really high valuations. You're not in that boat. Like if you try to go into that boat and try to pitch and be with those folks, the VCs are going to know. It's not like you can trick them to say we're an AI first company. It's like, well, no, not really. You're a SaaS first company and you use AI for one or two features and that's it. Like you can't BS your way into that. So you have to kind of understand what your market is. Two is to then go in and say, okay, who's actually investing in this market? I will tell you, if you look at all the charts from PitchBook, et cetera, if you are not AI native, you see a lot more dollars falling off. You see the valuations are much lower. So you have to find that group that is actually investing in that. You might have to get introductions and proactively start to build that relationship before you need that money, because you might not get that bridge. You might not get the venture debt. So you actually have to start to build those relationships and start that process a lot earlier. So I think it's just prepping. It's building those kind of foundational points of who do I want to go after? Who do I want to build a relationship? And if you are in the non-hot bucket, you do have to spend the time. You do have to create the newsletter. You do have to give those custom updates. And as CEO or as a co-founder, that's your core job, is to keep the lights on. And so you've got to make that investment.
It's a really different playbook. The Handbook of Founder Mythology has whole chapters dedicated to creating FOMO, and as though that's the one and only way to do it. What do you think of that?
That playbook is too old now. Like, if you actually have a term sheet, absolutely play that and run with it. You got a term sheet, get the best offer, try to get some scale, try to get some value from that standpoint. Absolutely. If you do not have a term sheet, VCs know when you're bluffing. Like, it's playing poker with somebody. It's like, if you don't have a term sheet and say like, oh yeah, I got some offers coming soon, I'm having some really deep conversations, like, that means you don't have anything at the table, because if you had something, you'd say, I'm going to get a term sheet tomorrow. And so I think it's hard to bluff, but I do agree, like on the term sheets, like, you can build that demand. Say, hey, we're about to close, or hey, I've got 4 people preempting right now. If you are interested, let me know so we can have that deeper conversation, so we can get that data room set up.
Yep. How did you learn to fundraise, especially across these two different environments of being in the hot and the cold?
Yeah. For me, I think from a fundraising perspective, it was seeing others do it when I was kind of an employee at an early stage startup, to be invited into some of the meetings, and then always kind of going in and saying like, why did they not follow up? What happened? And like, you got to ask some of those tough questions like, hey, I thought we were pretty far along and I don't see the check and we're not announcing anything. Because you want to learn from those mistakes that might have happened. And it's not necessarily the company's mistake. It could have ultimately been the investor's mistake because they missed out on an opportunity. And so I think it's kind of learning from what others have done in the past has been really important. There are certain VCs that have a hard time getting into the hot deals. The hot deals are hard to get into at certain points. So they will be kind of that mid-tier kind of investor. Those mid-tier investors, you should invest some early time into to pressure test things. And it's not to be an asshole to waste anyone's time, but it's going in and saying like, hey, if they express interest, or you've got a contact at a VC where you're like, hey, this isn't Andreessen Horowitz, this isn't Iconic, but it's like, it's a solid VC. Maybe they do as many investments. You should take that call. You should go in and have an honest conversation, like come in with confidence, like, hey, we're not raising right now, but what do you think about this? Like, would you invest if we were raising right now? And just asking those tough questions. And then the last piece I would say is never get offended that they turned you down. I think so many people take it personally. It's not a personal thing. It's like selling something. If you sell something, it's not every sales call actually results in a conversion. Every pitch does not result in a conversion. Every follow-up does not result in a conversion. You have to be okay with rejection, but you have to go in and say, like, what didn't you like about this? Like, what sucked about this that you don't want to invest? Because you're not going to burn any bridges. Because you have to assume if they rejected you, they're not going to come back. I've never had a VC reject me and say, like, hey, I saw you did a really good job on this. I'm going to come back now. Like, when they straight up reject you or ghost you or don't follow up, just ask them, like, hey, can we jump on a quick call? Doesn't even have to be recorded. I'd just love to get your feedback on what you thought.
And you ask for that feedback proactively, and you get it enough of the time to learn.
Exactly. And you got to be open versus like trying to defend yourself. I think that's the wrong thing you can do to defend yourself.
See so many entrepreneurs who, when they get a pass from an investor, they talk about why the investor was wrong and what the investor missed.
Yep.
And it sounds like you're saying instead, let me not waste any time accusing them of being wrong. Let me just go find out. What did they see? What didn't they see? And let me take it as data.
Yeah, no one closes a deal by going in and saying, you're wrong, this is incorrect. Like, that's never going to happen in this world.
So there's a lot that's outside the founder's control, but there's also, it sounds like a lot of things that you believe are inside of founder's control. And there might even be some data that's at the ready that they could otherwise miss. What do you think is in a founder's control? What should founders obsess over?
I think delivering the product to the consumer. If you have the worst pitch in the world, if your metrics are the best in the world, you'll still get funded. You'll still do incredibly well. If you look at some of these companies right now that are raising money, some of the CEOs aren't great speakers. A lot of them are like 20-year-olds or 25-year-olds that have never done this before, but they're raising money because the metrics are so strong. So I think as long as you are focused on the core business and you can move the needle on the metrics, that's going to be better than any storytelling you can do. But after that, it is the storytelling. It is what do you want to communicate in a short amount of time that gets them excited, that hits the point. So it really is a sales process. It's doing the sales research to say, who's the partner that I'm talking with? What did they invested in? Is there anything competitive? Where they have big wins? And salespeople do it all the time. So founders shouldn't feel like they're above that. Salespeople go look for the video. They like the LinkedIn post. They do all of that stuff because it drives results. And I think the more that you can relate your pitch to the investor, the better outcome that you're going to get.
Talk to me about pitch decks. Do you have a philosophy of what a pitch deck should be like?
Yeah. So I'm not a big pitch deck person in general. I will say in early stages, what I've seen is it is a good conversation starter. So if you're early stage, there is no secret sauce. If you've got some idea that's going out there, like generally no one's going to steal it. Like they have to execute against it. They have to do a lot of work to actually make it into a product. So you should actually feel comfortable sending in a deck. And again, I actually wouldn't make 30-page decks, but it's like, what's a deck that I could send as a pre-read to get you excited about the business, that I don't have to go over all the basics, but you're kind of like, check, check, check. So now I'm going to ask really meaningful questions. That's what the pitch deck should be. The pitch deck isn't about selling them to invest. It's really selling them to say, let's have a more meaningful conversation the next time.
Yeah. If you could leave up-and-coming founders with fundraising advice, what would it be?
That's the tough one. I would go in and say it is really difficult to raise money in a traditional fundraising sense. Like I've been in the space now for 30 years and it is very hard to raise like 98% of the time unless you were in the right sector at the right time. But you can't control that. That's the market going in. What you can control is your team. What you can control is the story. What you can control is the actual product that you build out and actually selling to people and going out in the market and getting that real feedback in market. Those are things that you have control over that you should work very hard against, but don't try to time the market. Don't try to pivot into what is hot right now, because what is hot right now could not be. So we were at crypto winter 2 years ago, and now we're back. And if you had gone in and kept switching around, you wouldn't actually build a great product to solve a problem. You would be going and chasing something else. We chased NFTs. Like it was hot for a while. If you were there at the right time, you printed cash for a couple of those companies, but everyone who followed after that, they're kind of going and saying, what's next? I got to pivot, or I'm going to shut this thing down. I have to do something else. So I would very much avoid chasing what's hot and really focusing on things that you have control over.
Yeah. I mean, a lot of what you're talking about that makes the difference is out of your control. The right timing. I remember Bill Gross at Idea Lab did a detailed analysis of their startups and what correlated with success. And out of the 5 factors he looked at, the number one biggest influence was, were they at the right time? Mm-hmm. And in a sense, a lot of that is beyond your control. A lot of that's environmental. But David, you made some deliberate moves of saying, hey, if my timing isn't quite right for my own company, my own raise, I'm not going to force it. Let me instead manage cash, manage the business to actually move it into a situation where it's going to be more fundable rather than less fundable.
Mm-hmm. Yes. Create a business that is fundable, but also giving yourself enough of a runway. So there were times in 2022 and 23 where we slowed down hiring. We said like, hey, do we want to hire someone or do we want to extend out the runway a little bit? We made the right decision to say like, hey, let's pause until we get product market fit that we raise that next round and then go really aggressive in the hiring process. But your job is really to go in and make yourself fundable, but also give yourself enough time to be fundable as well.
Is that part of your overall philosophy of how to make these startups successful?
Oh yeah, absolutely. Because you don't know when your thing is going to hit. So if I had built this in 2019, I probably wouldn't be around because the market wasn't ready. Video conferencing platforms weren't set up to allow for measurement in real time. All these things had to come into play. And it was, again, timing. There wasn't a solution for the problem that I had, that many millions of people had. It wasn't the right time with AI, where if OpenAI had waited another 12 months to come out, or Anthropic didn't come out like 12 months later, that would have been a very different space. And we might have worked on a large language model because that wouldn't have been available. And if we built a large language model, I know a couple companies that did this. And then once OpenAI came out, they're like, oh, this was bad timing.
Yeah. And even Read AI, with the timing you had, which was pretty favorable in so many ways, you were working relentlessly to make sure that the product was really maximizing that. You're very data oriented and you're very much interested in saying, okay, what's working, what's not realistically. You don't have happy ears.
Yeah. And that is the directness that we talked about earlier. That is also giving your team the right metrics to go in and say, this is the North Star. So the early team that we built was really focusing around, okay, if it doesn't work, that's okay. What's the next thing versus trying to salvage something that the market didn't want at that time? So there were no sacred cows at the time. We were kind of like, okay, it doesn't work. It's all right. Let's go do something else because the metrics are going to do it. I'm not going to try to be right. I'd rather find the right thing.
I love that. I love that it's from the very first thing we talked about, that directness, that everything else emanates. Well, congratulations, David. Congratulations on all of the progress with Read. I am a Read user. I love that Read actually gives me data on what's happening in my Zoom meetings. Those are the rhythm of my life. So if I'm not getting better at those, I'm not getting better at the most important things. So cheers to you for creating that for me and for everybody with Read.
No, I appreciate it, Ben. And that feedback means a lot. So I really appreciate that.
Awesome. Thank you, sir.
Thanks for having me.
I loved this conversation with David because he has been through it all. He has been through amazingly hot markets with a very hot company, and he's been through terrible markets with a very tough grind to raise venture dollars. I think the thing that stands out is that finding investors for your company is not one size fits all. He's really attuned to how you have to have the right positioning for the right investor. Sometimes that's clear and easy when the stars align, like in his back-to-back venture rounds during the video conference boom. But when it's not, what he also talks about is that getting feedback and making adjustments is absolutely key to finding that fit with investors. Timing can be really powerful. It matters a ton if you're in a hot market or a cold market, a hot sector or a cold sector. But regardless, one of the things that came through with David is that the CEO has to know and build to the right metrics and the right outcomes that are going to earn that investment. I think that's pretty neat because it says that fundability can be in your control. And it gives this overlay, which we've seen over and over again from outstanding fundraisers, that they're designing for a great business and for fundability at the same time. I hope you picked up some great insights that are going to help you sharpen your own business and your positioning, and I hope you can use those to give yourself an edge. If you enjoyed this episode, please do me a favor, subscribe to Razor's Edge on Substack or Spotify or Apple Podcasts. Thanks for listening.